Hello and welcome to my project, my final year project, which is aiming to optimize a portfolio with low risk that invests in the foundational layer of the AI value chain. I started off the project by importing the necessary libraries and being able to and setting the option that I could see all the rows and columns of my data sets, and I set a start and end date between the 31st of December 2021 and the 31st of December 2025. The first ETF I imported was the SOX ETF, which invests in semiconductor companies, and this is the top 25 holdings here in a Python list. I used the Yahoo Finance libraries function download to download all of the tickers, all of the stocks price data, price data between the start and end date, and setting the auto adjust to false, as it would automatically adjust the close prices and sometimes show negative close prices, which would mess up my results. Then I decided to use only the close prices and ignore all the other columns, and had the data, or set it to date time as well, and used forward fill. So when I first imported the data, there were about three issues with null values. So firstly, the different since this is an ETF that invests globally, different markets open at different times. For example, the Saudi Arabian market is open from Sunday to Thursday, whereas the American or European markets are open from Monday to Friday. So this forward fill carries over the previous day's price onto the next day's. There was also another issue with null values, where, for example, this A-Lab stock hadn't had its IPO, hadn't been released on the stock market till later on, or halfway between this start and end date set. So the forward, rather than using one massive fill all null values with average or with mode, I decided to use forward fill helps with that as well, so that all the null values past the first day that the stock was released get set to the previous day's close price. And then, there was another issue of sometimes the stock names have change, and so sometimes there were entire columns missing, and so I had to manually find the companies on Yahoo Finance and find the correct ticker to import. I then did this for another ETF pick, which invests in metals and mining globally. MXI, which invests in global materials, usually for construction of data centers. The FTSE for broad utilities, which is the gas, electricity, and even the water sometimes that powers these data centers. And then PAVE, the global infrastructure development, further invested in data centers and electricity grids. TAN, which invests in solar producer and suppliers, and more data center real estate and infrastructure, DTCR, and finally Volt, which invests in the electricity demand for data centers. Then I moved on to doing a GARCH. I used the GARCH model to do volatility forecast. So I combined all the data, all the 8 ETFs top 25 holdings, and found that I had 197 stocks in the data set. Then I removed the duplicate ones, as some ETFs invested in the same stocks, and I was left with 154 stocks in my final combined data set. Shut them here. Yep. And then I worked out the returns, which is simply the percentage change, the daily returns, which is simply the percentage change times 100 to make it readable as a percentage. And from that, I worked out, or with that same data set, I worked out the volatility of each individual ticker, annualized as well, as per usual in financial engineering, which has been made annualized, or the volatility, which is the standard deviation, which has been annualized, as there are approximately 252 trading days in a year. Here we just see the top 20, or the first 20 in the data set. Then I begin installing the Arch model in the Arch library. And so I change every column so that it's easy to use in the Arch model. I change each column to a series where I'm dropping the null values, which means that the variance is being forecasted for not only from the start date of the data set, but also for those same stocks that may have been released or may have come to the market in 2023. Their first price would or their volatility would be worked out correctly. Then the GARCH model, or I chose to use a GARCH model and assumed a mean of a constant mean and assumed a normal distribution of the returns. And the constant means that the average does not change over time. So the Garch model adds the p-value into the Arch model, and this generalizes the volatility over time. So the p-value is the number of lagged delayed volatility terms, or represents how long it takes shock-induced volatility to decay, whereas q, which is the only value in the Arch model originally, is just the number of lagged residuals errors, and represents how impactful the news is on volatility, or how impactful yesterday's news is on volatility. I stuck with a Garch 1-1 model because it's often observed that anything above 2 for either variable often overfits data. I then fitted the model and saved them into results, and then forecasted the next 5 days of the next trading week in variance. So this is for each stock. I just have the next 5 days of variance forecasted. And variance is different to volatility in the fact that variance is the square of volatility. However, when we're displaying the variance here, it is in percentage form. So, for example, SRE here would be 0.142, and that square rooted would show an 11% or 12% volatility, for example. I then printed all the summary statistics of the volatility model for each individual stock, and I analyzed the summary statistics of the volatility model and made sure that each p-value was below 0.05, which is the 5% confidence level for both the alpha and beta coefficients. So, for example, here this is statistically significant because both of these values are below 0.05. The omega and the mu both don't have as much importance, but it's obviously ideal if they are statistically significant. The statistical significance helps me to ensure that the stocks I'm choosing to further filter or to filter out, that the volatility model has correctly predicted their future variance, and with some certainty that it believes that will be the future volatility. So then, after manually checking each one for statistical significance, I found the ones that did have statistical significance here, and then I created a for loop that just shows the total trading week volatility, the next 5 days of forecasted variance for all of them, for all of the filtered stocks, which is here. I've filtered the same ones out. And then I made it to a pandas data frame so that I could add in an industry section next to it, just to realize just to see what the industry each stock was in. So here I used the Yahoo Finance library again to get the ticker information, where it provides the industry information on the website. And yeah, and so I just put it into a table and began searching through these manually again, just to make sure I was getting a nice balance of data of industries that they were in. For example, these REIT ones would be data center, and a utility, regulated electric utilities, would appear in the electricity or utilities sector. And for example, there were a few semiconductors here as well, for example, Qualcomm, that were included in the final portfolio as well. So then I moved on to creating the portfolio, which began with creating a list, or importing the same starting libraries and settings, and creating a Python list of the 25 stocks that have a balanced industry selection as well. I then downloaded this data in the same way I did for the ETFs. However, there was a problem with these ones, as these 6 stocks were all in different currencies, as ETFs like to hold assets from the country that on the stock exchange in the country that the companies originate from. So, for example, Tata Steel is a is an Indian company, and therefore the ETF that I found invested in the on the Indian stock market. So I had to convert these currencies all to USD, as the portfolio returns would be all out of shape, and it wouldn't give me an accurate result unless they were all in the same currency. This was pretty easy with most of them, as I imported the currency exchange rates from Yahoo Finance as well, and simply multiplied the stock prices by the conversion rates on each day, so that each day I was getting a different currency conversion rate, and it was adjusting the price per day. This worked quite well with all of them, and a few changes had to be made with, for example, the Israeli agora, because the agora is, for example, how we have pennies and pounds, and there's a lot of Israeli stocks like to trade in agora, which is just smaller incremental cents, for example. So it just required a divided by 100 in the calculation. The same with the South African cent, as I had to import the South African rand currency conversion rate. And for the Israeli agora, I had to import the Israeli new shekel currency conversion rate. Okay, so then I just adjusted. I had my final portfolio all in USD, and I just simply had the USD currency converted stocks at the end here, and I dropped the original ones as well. Then I moved on to creating the portfolio. So I worked out the daily return, or the expected daily return of the portfolio itself, which came out to be 0.04%, which works out to about 7.5% across the year. But this was for an equally weighted portfolio. So I have 25 stocks, each of them being 0.04, or having 0.04 of the portfolio allocated to them. Then I plotted the cumulative returns, which of the equal weighted portfolio, which basically means if you put £1 into the portfolio in January 2022, by January 2026, it would be £1.40. Then I worked out the covariance matrix and annualized it again. And this covariance matrix basically shows the direction that two stocks move together. So if it's positive, that means the two assets move in the same direction together. If it's negative, then one might increase or decrease while the other one increases or decreases, and they're constantly on a balancing scale. And if it's zero, there's no relation at all. So the weights were changed to a NumPy array so that they could be transposed, so that we could multiply, so that we could do matrix multiplication with the covariance matrix. And so the dot product of the weights, the transposed weights, and then time, or the dot product of that, and the dot product of covariance matrix and the weights, the original weights. So the portfolio standard deviation worked out to be 18%, or the risk worked out to be 18% for volatility. And there's just a few summary statistics here. And so then I moved on to using the Pi portfolio optimization library. And so I worked out the average historical returns and set them to the sample covariance for my portfolio. And I set them to, I made the efficient frontier and had the average return in mu and the risk in sigma. So from there, I just printed out the weights of each asset in the max Sharpe portfolio. So the Sharpe ratio is expected return minus risk-free return divided by the portfolio volatility. Or in other words, for example, a Sharpe ratio of 1 assumes that you get 1% return for every 1% risk you take, for every 1% volatility you have. So these were the weights for the max Sharpe ratio portfolio. Lots of them ended up being close to zero. However, once I printed out the max Sharpe portfolio performance, I got some better statistics. I got some more in-depth statistics. The expected annual return was 11.3%. The annual volatility was considerably less than what the S&P 500 was estimated to be in 2025, which is ideal for my investors as they are looking for a low risk portfolio. The Sharpe ratio is suboptimal or below 1. However, the return is not something I'm aiming to maximize in this portfolio. So these results I'm pretty happy with. Then I just worked out the minimum volatility portfolio, which ended up with very terrible results. A Sharpe ratio of 0.38, and still it had 11% volatility. So the minimum volatility portfolio will not be used. Then to compare to the benchmark, which is the S&P 500 in this project, I downloaded the S&P 500 data across the same start and end date, and the auto adjust isn't there because the prices do not adjust for the S&P 500. I worked out, obviously got the returns, the average returns and the standard deviation annualized, the volatility annualized, and using the critical line algorithm, I then printed or created the efficient frontier object of my efficient portfolio and plotted it out with Matplotlib, and I included the S&P 500 over the past 4 years, as well as the Max Sharpe portfolio and the efficient frontier, or the line of where all the most efficient or where the best portfolios sit along the efficient frontier. So after visualizing it, the Max Sharpe portfolio actually does pretty well compared to the S&P 500. Then I moved on to working out the Kelly criterion, which aims to calculate the growth ratio or the expected growth of a portfolio. So I used the log returns, and this USD port just shows the price, today's price, divided by yesterday's price to get the growth ratio, which if it's above 1, obviously means the portfolio grew in value, and if it's below 1, it shrunk in value. I then worked out the average of the returns annualized and the average of, or the covariance matrix annualized. I analyzed the covariance matrix for the sigma value, and this bit of code just changes it to NumPy arrays so that I can use the library. And then the weights so I used the inverse. So the covariance matrix finds stocks moving together. However, doing the linear algebraic inverse of this eliminates this and rewards diversifying the portfolio. The @ then does a matrix multiplication with the average returns, the annualized average returns, and then this is divided by the sum of all the weights, but the absolute value, to make sure that we do not have negative weights, which would imply shorting the stock. Then, as full Kelly is often, it can often have extreme drawdowns, I used fractional Kelly or half Kelly to make the guesses or make the estimates more conservative and to just have a safer portfolio. Then I did matrix multiplication with the weights and the average return or the average returns. And then I worked out the volatility, which was the weights matrix multiplied with the sigma values with the covariance matrix, and matrix multiplied again with the weights. The growth rate was then done with this calculation, and it gave me a result of a 4% log compound growth rate, which is considered solid in context. And for extra context, an investor investing $100 in the portfolio after 1 year would expect a $104 return. However, after 18 years, the investor would expect that to be double. And then I created a GitHub to show or to manage my project. Thank you.